Let's talk about time frame and the risks historically of a diversified stock portfolio over varying points of times. So this is a 95-year chart of markets, and the next 95 years are not going to look like this necessarily, but let's talk about this. So if you had invested $1 in smaller company stocks over a 95-year period, it would have grown to over $56,000. If you had invested $1 in slightly more conservative, larger company stocks, more established companies, $1 would have grown to over $14,000. If you had left $1 in government bonds, it would have grown to about $177, so significantly lower amount over that period of time. And if you had left $1 in just cash or short-term instruments, it would have grown to somewhere between $15 to $20. So the idea is that the monies that you're not going to touch for 10 years or more ideally should be heavier in stocks and real estate. And the monies that you may need over the next 2, 3, 4, 5 years really should be heavier in cash and short-term instruments, because you could have, if you look at around 1929, you could have a 5-year period where you have a significant loss in the stock market. So ideally, you're not putting money that you need in the short run into the markets. So this is a chart of 1-year returns and 10-year returns of large cap stocks, going back also 95 years. So in the 1 year, you see this dotted line. You could be up 50%, down 50%, lots of volatility in the markets over a 1-year period of time. The red line is the 10-year average annual return of this basket of stocks. In other words, if you look in December of 1959, if at that point for the preceding 10 years, you would have had a return of almost 20% a year. If you look around December of 44, over the preceding 10 years, you would have had a return of around 10% a year. What's notable about this chart is that it is very rare where over a 10-year period of time, you would have had a 0 or negative return. So it's happened, if you look at this chart, on 3 separate occasions, the latest one being in 2009, which was a negative 10-year period called the lost decade. But over every one of these periods, the subsequent period of time was an extreme bull market. So it has been historically very rare for a 10-year rolling period for someone to have lost money. So here's another way to look at historical sort of market ups and downs. Over 1-year periods, 26% of 1-year periods have been down. So 1 out of every 4 years in the markets has been a down year. But if you put your money in the market for 5 years at a time, 13% of the time, you would have lost money over a 5-year period. So even that does happen. Over a 15-year period of time, historically in the United States, there have been 0 occasions where you would have lost money over a 15-year period. That number turns in the US to 0 at 12 years. So there have not been any 12-year or longer periods of time in the US markets where you would have lost money over that period of time. However, that is not to say that that will never happen. The best way we can put it is, don't bet against the long-term trends that have happened for hundreds of years, that being that stocks and real estate in the long run tend to outperform bonds and cash. But at the same time, just because that's been the historical norm, don't put all your eggs into that basket. So don't necessarily think that it's 100% done deal that stocks are going to be up in 12, 15 years. So think about investing in terms of time frame, and let's completely forget about making predictions and picking stocks. For more information, please feel free to take a look at our website at www.aireadvisors.com. Thank you and happy investing.